All right, let's tackle one of the absolute toughest questions any investor has to deal with. The market's getting wild, so should you pull your money out? You know, it's that classic battle between your long-term goals and that short-term panic that just screams at you.
So picture this. You're looking at your portfolio, and all you see is red. The numbers are dropping, and every single instinct in your body is shouting, "Get out! Sell now! Protect what's left!" But what if I told you that listening to that gut feeling could be the biggest mistake you make? Let's dig into why.
You know, when things get volatile, that temptation to just liquidate everything and run for the hills is so strong. I mean, it feels like the only smart thing to do, right? But here's the catch. Moving all your money into what you think is the safety of cash, well, that comes with its own set of very real and often totally hidden risks.
And hey, let's be fair. That impulse to sell, it's completely understandable. There's a really powerful psychological reason we crave the comfort of cash when a financial storm hits, and it really just boils down to one thing: a feeling of control.
And that need for control makes perfect sense, doesn't it? When you're holding cash, you've stopped the bleeding. You're officially out of the game, so you don't have to worry about market risk anymore. You can log into your bank account and just see a nice, stable number, and wow, is that soothing. For that one moment, it really feels like you've won.
But, and this is a big but, that short-term comfort can be a total illusion. It's one that could cost you big time in the long run. The data's pretty darn clear on this. What feels right in the moment is often the complete opposite of a smart long-term financial move.
So let's really unpack the true cost of cashing out. We're going to dive into 3 hidden dangers that most people just completely overlook when they follow that gut instinct to sell in a panic.
Okay, first up, let's talk about a really crucial idea: the paper loss. So when your portfolio's value goes down, you haven't actually lost any money. Not yet, anyway. It's what we call an unrealized loss. It only becomes permanent, it only becomes real if you do one very specific thing. Think about it like this. A paper loss is just temporary. It's a potential loss. Your portfolio can still bounce back when the market recovers. But the very second you hit that sell button, you turn that potential loss into a real permanent one. You've locked it in. And now there's just no hope of getting that specific money back through a rebound.
All right, let's get to our second danger. This one is a lot quieter, but believe me, it's just as damaging. I kind of like to think of it as the silent thief, always working away at your money whenever it's just sitting still.
And yep, that thief is inflation. See, a market crash is loud, it's dramatic, it gets all the attention. But inflation, that's the silent killer. It's the force that's just eating away at the value of your cash every single day. So while your bank balance might look stable, its actual buying power is quietly, but absolutely, guaranteed to go down over time.
And that brings us to our third hidden danger. This one isn't so much about what you lose when you sell. It's about everything you fail to gain by sitting on the sidelines.
We're talking about opportunity cost. By holding on to cash, you're not just losing buying power to that silent thief, inflation. You're also missing out on the market's eventual recovery and all the growth that comes with it. History has shown us time and time again that the stock market is one of the best ways to build wealth long-term. Sitting it out means you're just giving up all those potential gains. So all 3 of these dangers really point to one massive flaw in that sell now, buy back later strategy. It all relies on something called market timing, which, let's be honest, is basically a trap.
It really comes down to this simple idea. We all know the #1 rule of investing is buy low, sell high. But what does panic selling make you do? The exact opposite. You most likely bought your investments when prices were higher, and now you're selling them when they're at their lowest. It's a guaranteed recipe for losing money.
And just stop and think about this for a second. To successfully time the market, you don't just have to be right once. You have to be right twice. You have to perfectly predict the top so you can sell, and then you have to somehow magically predict the absolute bottom to buy back in. I mean, if you couldn't predict the peak, what on earth makes you think you're going to nail the bottom? It's so incredibly unlikely. Okay, so if cashing out is a trap, then what's the alternative? What are you supposed to do? Well, let's explore a much more disciplined and frankly, a much more successful strategy for getting through a downturn. You know, there's this core principle that really just says it all. The simple truth is that the long term favors people who stay invested. Investing isn't about trying to dodge every single dip in the market. It's about endurance. It's about staying in the game.
And history shows that the people who have the discipline to do that are the ones who get rewarded in the end. So instead of hitting the panic button, the smarter thing to do is to just zoom out. Remind yourself that historically, the market trends upward over time, except that these downturns are a totally normal, even unavoidable part of the journey. And if you feel like things are getting a little out of whack, don't sell out, rebalance. It's a much healthier approach where you just adjust your investments to better match your actual goals and your comfort level with risk.
Which kind of leaves us with one final thought to chew on. When the market is falling, all the data suggests that the biggest risk you face might not be the red numbers on the screen. The biggest risk might just be your own emotional instincts telling you to run for the exit.